The Retirement Savers Credit, a special tax credit that you get for saving up towards your retirement. Does contributing to the Roth actually qualify you for this special benefit? I've got that answer and more coming up. My name's Mike Bernard. I'm the host of the Wise Money Show. I'm also one of the certified financial planners right here at Korhorn Financial Group. Make sure you hit that subscribe button, turn on notifications, and smash that thumbs up button. Deductions are good, credits are great. Deductions are good, credits are great. When you're looking at your taxes, you add up all of your income, wages and interest and dividends and capital gains and retirement withdrawals, business income, Social Security, all that sort of stuff. You add it all up, okay? And then once you total up all your income, you then subtract deductions, okay? So deductions are good. They reduce the amount of income that you pay tax on. So your standard deduction, call it 30 grand, comes off your all of your income, and then you pay tax on that net amount after your deductions. So deductions save you a percentage of tax. Those are good. Credits are great though, because after your income minus all your deductions, you calculate your tax. This is the amount of tax that you owe, and then you subtract it dollar for dollar for the tax credits that you get. Child tax credit or premium tax credits for getting your health insurance through the Affordable Care Act, American Opportunity Tax credits, and also a very special tax credit for saving up into retirement. This is why it's my favorite tax credit, our favorite tax credit, because you want to save up for your retirement anyway. It's your retirement. And if you can get a tax credit, a dollar for dollar reduction in your tax bill for saving up for your retirement, oh my goodness, take advantage of that every time it comes up. Recently, we're helping some clients that are semi-retired and doing some proactive tax planning for them, guys, and it was just unbelievable. We added strategy on top of strategy on top of strategy. It's like 3 or 4 different approaches that we took, and we're able to really maximize their situation. They paid very little tax, and this question came up. Wait a second, the Retirement Savers Credit, do I get that if I'm contributing to a Roth? And I get the basis of their question, because when you're contributing to the Roth, you don't get a benefit this year. There's no deduction. Like you might have thought that, in very simple terms. When I contribute pre-tax, I get a benefit today. I get a deduction today. When I contribute Roth, I don't get that benefit today. And the other reason this is a good question is with the Roth, I mentioned in this scenario, these folks were semi-retired, but with the Roth, you make a contribution if you needed that money. And this isn't a feature to promote. But let's say you contributed to the Roth and then the very next year you needed that money back, you can actually withdraw your contribution right back out. And there's no tax, there's no penalty. Even if you're younger than age 59 and a half, you can take your basis out of that Roth IRA. So it's a fair question to say, wait a second, does contributing to a Roth actually qualify for this special retirement savers tax credit? It does. Yes, it does. Contributing to a Roth IRA or a Roth 401k, 403b, yes, that counts and qualifies for the contribution towards a retirement savers tax credit. Be aware of that, and if it makes sense, if you already qualify for the retirement savers credit, and I'm going to show you that eligibility here in just a second, then and the Roth makes sense, oh my goodness, do the Roth, because yes, it absolutely qualifies for you and your spouse. There might be a reason, depending on your situation, where you might want to contribute pre-tax instead of Roth, even though a Roth could count. And let me explain. All right, so what's the retirement savers credit? Who's eligible? Okay, so again, this is a tax credit for making a contribution to a retirement plan. Okay, a Roth IRA, Roth 403b, that is eligible. That's one of the retirement plans. Who's eligible? You got to be at least age 18 or older. You can't be claimed by someone else. You can't be a dependent on their return, and you can't be a student. That includes being a college student as well. After that, you've got to have earned income, right? You've got to have paycheck money in order to contribute to retirement, but your income, your adjusted gross income, needs to be below a certain threshold. This is a tax credit for saving up for retirement when your adjusted gross income is actually low. And I get it, I appreciate it. This is basically the IRS saying, or Congress setting this up, that listen, if your income's actually lower and you're still contributing towards retirement, we're gonna give you an extra benefit above and beyond what you otherwise would. Now, what do we mean by lower? Take a look here. Married filing jointly, if your adjusted gross income is below $76,500 and you're saving up for retirement, then you qualify for this retirement savers tax credit. Head of household, your income needs to be below $57,375, and single or all others, it's got to be below $38,250. This isn't a piece of cake. It's no slam dunk, okay? But here's where the credit gets a little interesting, and why, even though a Roth could qualify, you might want to do pre-tax depending on your situation. The tax credit, how do you calculate it? It's on the first $2,000 that you or your spouse or both of you guys contribute towards retirement. And if the lower your income goes, the more the tax credit is. That first threshold is 10%. So if your income, married filing jointly, is $75,000, okay, that's below that $76,500, and you get a 10% tax credit on doing $2,000. So married filing jointly, you contribute $2,000 to the Roth IRA, your spouse contributes $2,000 to the Roth IRA, that's a 10% tax credit on each. You just saved $400 on your taxes. But say your adjusted gross income, married filing jointly, is below $50,000. Say it's $48,000. Now your tax credit, based on this, you're in that second tier. You get a 20% tax credit. So you contribute $2,000 to your Roth, your spouse contributes $2,000 to your Roth. Instead of $400 in tax credit, it's now $800. And lower still, say your adjusted gross income is $45,000, married couple, and you're now below that last threshold, it's a 50% tax credit. You contribute $2,000, your spouse contributes $2,000. That is a $2,000 tax credit on your tax return. And you might say, how are you contributing towards retirement if your income's below this amount? You're early in your career or you're late in your career. In this instance, with these folks that we were serving, they're semi-retired, they were living off some cash, but they were still working and had enough income as well, but their modified adjusted gross income was very low. Modified adjusted gross income was just above $50,000. So for one of them, we did pre-tax contributions, okay, to get them below that threshold. And then for the other, we did Roth so that we brought them into that better tier of retirement savers tax credit, but then still did Roth since they were obviously in a very low overall tax situation. And because of how these tiers work, you can see, yes, the Roth does qualify for the retirement savers tax credit, but if you're close to one of those thresholds, you may want to do pre-tax so that it moves you into that lower threshold so you get an even higher retirement savers tax credit. So that's a little bit of how it works. And yes, the Roth does qualify, but guys, you're likely going to miss out on all the goodness of this tax benefit and this tax credit if you're not doing proactive tax planning. I told you, these folks that we helped with just recently, we weren't exactly sure the business income and part-time work that they were doing, how much income they were going to have. So we basically said, listen, we're probably going to fund a retirement account for you guys, maybe both of you, but we're going to wait to see how your tax return turns out, and then we'll make an adjustment on the fly. And so for us, yes, it was tax planning, but based on their situation, that's the proactive, creative work that you need as well. So work with your certified financial planner on that. If you don't have a CFP on your team, you can contact one on my team. Find us online, Korhorn.com. That's Korhorn with K, wisemoneyshow.com. You can find us there as well, or send us an email, info@Korhorn.com. All right, there you have it. Go out and take your next wise step in your financial life.